him.
Or a woman? I won't be doing this type of video very much, maybe just for big events. I don't want this to turn into a stock market news channel. You've got CNBC for that. But I do want to talk about what's happening in the markets right now. There's a ton of speculation going on, from this is going to be the worst stock crash in history to buy the dip. One of the more restrained views is that funds are rebalancing. I think that's pretty reasonable. I do want to say before we get into it that the stock market is the combined views of millions of people. To think that one thing is moving the market, one event is causing everything, is probably the overreach of the human mind to try to find meaning in chaos. And add to that, I'm not a prophet. I can't tell you the future, but I am telling you what I think may be happening. As I said, there's a lot of talk of rebalancing portfolios. So if you watch business news, they might be saying something like, funds are switching gears from tech to cyclicals, or something like that. I want to show you why that might be. And bear in mind, it isn't going to just be funds doing this. I would think that most people who are involved in the stock market would be doing this to some degree. But what a fund will do is feed the excitement. They'll stimulate it. So that's why you have the market reaching these crazy highs. So what do I mean? A newer investor is going to invest in Apple. They're going to invest in Tesla, Netflix, Amazon, big names. Also, if you're buying a fund that mirrors the S&P 500 or something like that, guess what you're buying? All those companies. Then other funds get in there and buy those companies too. But the funds know when to get out. They know when to leave the party. Whereas the small-time investors will say something like, Apple's down 5%, time to buy. And maybe it is. We'll look at that in a minute. But add to that a stock split. Apple and Tesla both recently underwent a stock split. You know why? It's to attract small investors, isn't it? Funds don't care if a stock is $100 a share or $1,000 a share. Small investors care. And companies want to raise money, so they want small-time investors in there. When Apple stock does a 1-to-4 split, and its share price goes from $500 to $123 overnight, aside from it looking cheaper and therefore good to invest in, what happens in the mind of a small-time investor who maybe doesn't know everything about the stock market that a fund manager might know? There's confusion. That's what happens in the mind of the small investor. Confusion. A small-time investor's mind is forced to either learn or ignore. If you bought in at $400 and Apple's stock went to $500, and now Apple's stock is $120, where's your new buy-in price? What's the equivalent of $400 after the stock split? That's confusion. Add to that, most stock news is done in percentages. 400 to 500 is a 25% increase. But 500 to 400 is only a 20% decrease. So what is that after the stock split? What's 20% decrease? Confusion. Then there are PE ratios. On the app I use, the stock split has not been properly accounted for, and it shows Apple's price to earnings ratio being under 5 at the beginning of the year, which it most certainly was not. And it says there is a current PE ratio of under 10, which it isn't. PE ratio shouldn't be affected by a stock split. But in some instances, depending on the app or website you're using, it can be. What does that cause for the small-time investor? Confusion. Many new investors think a PE ratio is the most important metric, and most people unfortunately ignore confusion. They power through it, and that can be a problem when knowledge is power. So let's look at what is going on exactly using two stocks as examples. I briefly alluded to the fact that there are two types of stocks in the market right now in other videos I've done. There are those that are benefiting from the crisis, and there are those that are not. So let's quickly look at two great companies from each camp. The first will be Apple, since we're already talking about it and everyone knows about it. Let's start with Apple's revenue. 2018, $265 billion. 2019, $260 billion, so $5 billion less. The first 2 quarters of 2020 are looking good. Not incredible, but good. Apple does a lot of business in the last quarter of the year, so it's a little early to tell how it'll pan out. I'm not saying Apple's doing badly. Don't get me wrong, they're doing well. But let's look at their price. Their price has almost tripled since their March lows. But you could easily argue that the market was in a panic in March, so of course the price should be up from there. Okay, since its highs at the beginning of the year, when it was around $80, that is price adjusted for the stock split, it has gone up about 67%. That's pretty good for a company that really isn't doing any better than it was 6 months ago. Apple is one company that benefited heavily from the crisis. And there are reasons for that. We'll look at them in a minute. But first, Let's compare it with Atlas. Atlas is a company that I've done a video on, and you can check that out if you want. I think it is a great company. They own C-SPAN. Maybe you noticed that company if you live near the ocean. Their ticker symbol is ATCO. If you look at their revenue, it's up in a big way since the last quarter of 2019. Their revenue is up 26% since the second quarter of 2020 versus the last quarter of 2019. They're doing decidedly better during the crisis. So almost certainly, if Apple's stock has gone up 67%, Atlas must just be soaring. Well, no. It's spent most of its time since March down about 50%. Money's starting to flow in now as funds start to rebalance their portfolios, but for the most part, it's gone unnoticed. C-SPAN is crushing it, and the market doesn't care. Why? Why is this going on? For starters, companies like Apple, although they make a ton of physical products, are getting lumped in with companies like Amazon that aren't supposed to depend on physical storefronts. That's the dream business in a crisis like this, or maybe Netflix. So because Apple can sell you a video game or an app without you having to brave the crisis, it's seen as being a better investment, and that made sense at first. But Apple sells a lot of physical products too. Same with Amazon. They're a prime, no pun intended, example of a company that's seen as being completely independent of real life. But guess where that cheaply made purse came from? Guess where those Nike shoes came from? Nike, by the way, is doing well since the crisis. Guess where most, if not all, of your cell phone came from? Overseas. It was shipped here on a boat. More so than ever. Not much is happening by plane. But that doesn't really answer why. Why is Apple up and Atlas is down? Everyone recognizes Apple is a great company, and it is. So when the Fed starts flooding the system with money and individual investors are looking to buy something, what do they buy? Apple. And Apple is 6.4% of the S&P 500. That's a lot. So if you buy into a fund that tracks the S&P, which a lot of people do and is often seen as the better alternative to investing in an actively traded fund, you are disproportionately buying Apple. Add to that, Warren Buffett recently bought into it, which that alone can cause euphoria in a stock. It also has a long history of doing well, which are all pluses for Apple. And again, I'm not saying Apple is a bad company. Atlas, on the other hand, has little name recognition. Only a few months ago, it was known as C-SPAN. They just underwent a name change to Atlas, which causes an obscure company to be even more obscure. David Sokol, who is chairman of the board at Atlas and was once viewed as a likely successor to Mr. Warren Buffett and was a manager at Berkshire Hathaway, is also not as well known as Buffett. But he was a big part of selecting acquisition at Warren's company until his abrupt resignation. All of these things, although not negative, do keep a company like Atlas out of the minds of investors. So what is the better deal to investors? On paper, it looks to me like Atlas would be a better buy. And I could see a lot of funds rebalancing and taking some of their money from investments that have performed well and putting it in underperforming yet highly deserving companies like Atlas. However, that doesn't say anything about popularity, which probably should be its own metric. The popularity index would probably be an important tool for stock investors to have at their disposal. Maybe they have those at large funds already, I can't say. I've never seen one. But the popularity of companies like Apple and Tesla can't be understated. Anyway, those are my ramblings for the day. I hope you found something useful in there. Goodbye. If you like what you saw, give me the thumbs up and subscribe. And don't forget what I told you.